Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app. Hub24 is on a mission to empower advisors to deliver better financial futures for their clients. They are dedicated to customer service excellence and delivering innovative product solutions that create value for advisors and their clients. These are just some of the reasons why advisors rate them number one for overall satisfaction and why their managed portfolio solution has been rated best in market 5 years running. Hub24 believes nothing happens in isolation. So they're working together with advisors, licensees, and industry leaders to leverage their data and technology expertise to help solve key challenges in the delivery of financial advice, so more Australians can access cost-effective advice. Welcome back to the XY Advisor Podcast. I'm Fraser Jack, and today I'm joined by a returning guest, Michael Miller. Welcome.
Hi, Fraser.
Thanks for coming back. Now, it's been 12 months since almost 12 months since you were on the podcast. I guess we're about to find out what sort of changed, and from there on, looking forward, I guess. But how have you been?
I've been well. We're in lockdown here in Canberra, but much shorter than some of the other sort of cities and states, so can't complain about that.
Yep, absolutely. Now, you're on episode 206, which came out in October 2020. So if anybody is thinking about listening back to that episode, go hunting for it in that particular space. Now, tell us about, there's a few things I wanted to talk to you today about. One of those things is you've been writing a lot of papers on some of the determinations that are coming out of the Australian Financial Complaints Authority, or AFCA, and we want to get into that a little bit later. But before we do that, I wanted to jump back in time. You're obviously a planner in Canberra. You've been working for a number of years. You're a licensed planner. You've been operating your own practice. Last time we had you on the podcast, you'd recently moved to your licensee, but obviously you've sort of settled in there now. But I want to go back a bit further. Let's go back to your background, as in, I really want you to sort of talk to us about the story that you tell about your nan.
Yeah, no, I can certainly do that. My nan, so my dad's mum, her husband, so my sort of grandfather passed away quite young, so she was very involved in sort of managing the finances and worked as a bookkeeper and did some investing herself. And, like many people, Nan would send every birthday the card, and there was a little bit of a sort of cash gift or a check in there, which is all sort of fairly standard, and maybe a sort of a $5, $10 or a $20 note sort of back in those days. But one of the stories that I sort of tell, it was for my 21st birthday, the card came, there was a check in it, and I can't remember the actual amount, but it was something like, it was like $52.86. It was a really, strange number. And you just thought, what on earth is going on there? Like, why that amount? And it turns out that what Nan had been doing is she gave an amount to the first grandchild that turned 21, and to be completely fair with everybody, she had been indexing that amount to inflation as each sort of grandchild hit 21 along the way. So that's why I had this very, very strange amount.
Yeah, that's a magical moment in your life, right, where you start working out that, okay, that's a real thing. It's important. It actually works that way, and a pretty good lesson from your nan.
Yeah, no, and I think it's an interesting part of how we practice, in that there's a very numbers component to it, and I don't think people get into this without having some interest in the numbers, but there's a people and a values component as well that probably people outside of the sector don't think about or see as much, but certainly when we're in it, realise how much it actually drives everything that we do.
Yeah, I agree. I think it definitely drives some of the stuff we do. Now, tell me about, now obviously her name was Zoe. Tell me about the Zoe Miller Award.
So that's an award I set up a number of years ago, just with the local university here, the University of Canberra. That's where I did my undergraduate degree, and it's basically for their introduction to financial planning subject. An award for the highest achieving female of $500, and the idea behind that. Particularly the way the course was sort of structured at the university there is Introduction to Financial Planning is the first subject in a sort of a minor or a major that specialises in financial planning. But you get a lot of people who go into sort of very broad sort of finance or commerce degrees. And this was certainly for me, not necessarily specifically with that idea of, hey, I'm going to target financial planning when they first enroll. So I guess try to just make it a bit of an incentive to say, well, hey, try this Introduction to Financial Planning subject as one of your electives. And, hopefully that sort of grows on you as something that you want to pursue, because we are definitely severely underrepresented in terms of, women in financial planning. So just trying to, do something locally towards that.
Yeah, fantastic. This is an amazing initiative. Now, this is just an initiative that you've taken to help promote the new financial advisors coming through, women in financial advice, and you just take this initiative where you provide a voucher or it's an incentive, an award of $500 for a top student.
Yeah. Look, it is pretty easy to set up if you contact your universities. They're all quite happy to receive these donations and put them towards these sorts of awards or prizes.
Yeah, I think it's a fantastic initiative, and I would encourage other people to do the same thing. So thank you for sharing that story. Now, I remember just on that, I remember talking to Dr. Catherine Hunt from Griffith University, who teaches the masters there, and she was saying that very similar thing, that a lot of people come away, they find out about this financial advice thing, they really love it, and then they go away on their end of the semester or spend some time with their family. They come back and they say, "Oh no, I'm going to be an accountant." It's sort of it's a weird thing, isn't it? Where there's trying to create that interest in the financial planning as a profession, rather than just sort of falling back on your standard accounting degree.
Oh, yeah, look, I agree, and those pathways haven't been there for as long as they have for other professions. When I was studying my undergraduate degree, I went to the university and said, hey, well, does this thing get me what was at the time, the PS 146 qualification? And they sort of looked at me and said, what's that? And that was a while ago now. And I think things have gotten much better. And I know the FPA in particular is doing some work with a lot of universities towards that. But if at that time I had have said, I want to be an accountant, there's a very clear pathway that certainly wasn't there at the time, given that it's not all that recent anymore for financial planning.
Yeah, fantastic. So if anybody wants to check out that Zoe Miller Award, there's a website, zoemiller.info. They can go and have a little bit more about that. And I do encourage people to sort of, adopt the similar award at their local university. Speaking of the work that you're doing for the FBA, you've done a fair bit of work on their, conduct reviews and disciplinary boards. Tell us about what you're doing there.
So the Financial Planning Association, sort of before, the FACEA Code of Ethics, sort of came around. It has its own sort of code of professional practice and a lot of the practice standards that go behind that. If somebody has, done the wrong thing, then, you can be held accountable to that code. Now, part of that is, the people who, I guess, sit there and, make decisions about whether there has been a breach, and any potential sanctions are drawn from your peers. So it's practicing financial planners such as myself.
Yeah, fantastic. So it's giving that overview of somebody who's got their boots on the ground and having conversations with clients. So it's not coming from a point of view that you wouldn't understand. You don't get it, and that's probably a little segue also into some of the work that you do, I guess with AFCA themselves, where you do actually perform a role where you can help them come to determination, or you can give them an oversight or a review of what it might be. I think you call it a panel member. Is that correct?
Yeah, that's right. So part of AFCA's sort of process can be a determination made by an ombudsman. Now, there are a lot of stages that come before that where there might be sort of negotiations, mediations and conciliations between somebody who has a complaint and the AFCA term is a financial firm. But if it isn't resolved at those stages, it can go to that determination. And as part of that, sometimes the ombudsman forms a panel, and what that will have is a practitioner member. So that's the category that I sit in, and a consumer representative, just to, I guess, broaden the perspective to somebody who is regularly sort of representing consumers' interests, but then also somebody who's practicing in financial planning, so might be able to speak to, what typical practice or what might ordinarily be expected to happen.
Yeah, fantastic. That's I didn't know that was part of the process, so that's fantastic. Speaking of the process, can you give us a quick overview of what the process is if a consumer has a complaint and wants to make a complaint? What do they do, and then how does the process work?
Yeah, so certainly, and this sort of sits, I guess, a little bit pre-AFCA, is the first step is always going to the financial firm. So that might be if you have a dispute about advice, it might be a financial planner, but it may also be a dispute with a financial product provider. Is going to them, and they're all required to have a complaints process in place, and that's always your first port of call. If that hasn't resolved the issue to that person's satisfaction, they can then go to AFCA as an external dispute resolution body, and they then have, I guess, a bit of a process where they're trying to find a resolution between the complainant and the person or the institution responding to that, with, I guess, as little fuss as possible, in that there's often at the start of that process, just everybody sort of restating what's going on, what's been done so far, can we come to some sort of resolution, and then depending on how that goes, that can progress through that process, where I guess the final sort of stage is that determination that's made by the external ombudsman.
Yep. Now, you mentioned financial firm a couple of times there. Is this scenario a bit like ASIC with the Corps Act? They regulate corporations or firms rather than the advice provider that we've seen as the terminology used for, say, the Tax Practitioner Board or for SIA?
Yes, I guess in a way. So to bring a dispute to AFCA, the dispute has to be with a member of AFCA. You can't complain to AFCA about a firm that's not a member. Now, effectively, all financial services license holders or their representatives are required in the Corporations Act to be a member of AFCA. But of course, there are also, for example, mortgage brokers are required to be members of AFCA as well. So it's wider than just that sort of financial planning or financial product manufacturing part that we live in.
Yep. And there's been some conversation in the press recently about the actual amount of complaints that come from financial advisors versus other areas of finance. And you mentioned mortgage brokers and a lot of other finance areas that are involved. What are you seeing in that space with regard to the low levels of financial planners being dragged in?
Yeah, so I guess the parts that I play in terms of as a panel member, and then even just reviewing those determinations, I tend to focus on that financial planning side. So I don't necessarily see that wider picture, but certainly banking disputes go to AFCA. So while not everybody will necessarily have a financial planner, let alone a dispute with a financial planner, nearly everybody will have a bank account potentially a loan of some sort. So there are a lot of other sort of issues that they're dealing with, which then sort of flows through to, yes, financial planning is certainly not the biggest generator of disputes in what they handle.
And is the disputes generally because of a financial loss? Is that one of the key requirements?
Look, I think there's two parts to that. Is people probably don't go through that complaints process if there isn't some sort of loss there. So that probably influences it. And certainly the role of that dispute resolution is about putting the client in the position they should have been. So it's more of a compensatory function rather than a sort of discipline or professional practice type function. So yes, if somebody has potentially done the wrong thing, that they haven't conducted themselves in the way that they should, but there has not been a resulting loss to the client, then AFCA is not really where that's going to play out. That's more where things like obviously it's not finalised the structure just yet, but your single disciplinary body with the Financial Planning Association, their conduct review commission, it's less about that compensating the client or putting the client where they should be, and more about, actually, was this appropriate conduct, and what needs to happen if it hasn't been, to ensure that there isn't continuing poor conduct.
Yep. Yeah. Fantastic. And we'll get into a little bit more of that shortly. I want to ask you about the single disciplinary body. But before we do that, obviously, with your work as a panel member there with AFCA, and also it sort of led you into reviewing a lot of the determinations that have been made. Tell us about the papers that you write.
So it actually doesn't so much come out of the work as a panel member as for the textbook I've been working on. Part of that, so that's about ethics and professional practice in financial planning, and very much sort of, focusing a lot on some of the FACIA reforms, but also the other things, so things like that sort of discipline and compensation type system around that. Now, part of that was there's effectively a chapter in that where we're saying, well, what can we learn through the decisions that have been made in the past? And this is one of the things that's been said with a lot of the FACIA Code of Ethics, is because it's new, people are saying, well, how does this apply to actual real life scenarios? And FACIA, the body, has sort of put out some case studies and guidance around that. But what we have with AFCA is a lot of published determinations where they're effectively case studies. This is what happened. This is what was found about whether it was good practice or not. So it's really just, going through, reading those and trying to draw those lessons out, because we can all learn from experience, and as we get more experience, it would be terrible if we weren't learning something along the way. But particularly around some of these things, it's good to learn from the experience of others rather than just having to learn yourself through mistakes that have been made.
Yeah, 100% agree. And I want to get into some of these decision conversations and the work that you do with publishing these and providing some commentary around them. But just before we did, you mentioned the book there, the book you've been writing. You sort of talked about that in the previous podcast we did with you. Tell us about the book, how people can get hold of it, and what it's sort of about. Yeah,
so it's somewhat in the hands of the publisher at the moment, so I don't know the exact date, but I have some hopes that by the time this goes to air, it may actually be published. So the publisher is LexisNexis. They have an online store. So the title is Ethics in Professional Practice. And I think if you sort of just Google that with LexisNexis, or you can go to their website and start sort of looking through the financial planning category, that one is there and available. So they're taking pre-orders now, and hopefully not too far away from those actually being sort of printed and delivered.
Fantastic. And michaelmiller.help/book is a URL where you can put a pre-order in for that as well.
Yes, yeah. Well, that's just me sort of collecting a list that when it is available, I can send those details through.
Fantastic. Now, just while we're on michaelmiller.help, tell us about that brand.
Yeah, well, it's not so much a brand as just a sort of website I set up for things like publishing, these sort of writing up these decisions, and if you sort of have a marketing campaign where you need to direct somebody to a specific sort of page about that's somewhere that I can put that up.
Yeah, I think this is actually a really interesting part of what planners around the country can be doing is creating their own brand, having a space or a website where you can put individual type information or accreditation that may or may not be necessarily linked to the business that you're in or the existing business that you're in now. I think it's a good idea, and if anybody wants to check that out, jump on michaelmiller.help. I think it's a great place to have a look at something of what somebody's done that may help you. Now let's get into these decision papers and these determination papers that you write. I'm looking at one that talks about, I don't know if it's published yet, or it probably will be by the time this goes out, but it talks about the Q4 decisions that were made in 2021. Let's dive into it. Tell us what you're seeing in this space, because I think a lot of it was reflective of the last sort of 12 months, where everybody was sort of, do they go to cash? Do they get out of cash? All those types of conversations.
Yeah, that's right. So what that particular one is looking at is the decisions from effectively 1st of April 2021 through to 30th of June. So I'm basically doing this every quarter now, and what's been interesting there is that probably starting to see some of the complaints that were generated by issues that came out of that very sharp market downturn from the first COVID lockdown, which was sort of around about April 2020. Because once again, sort of thinking about that process is when something like that happens, which might generate things that may have caused a loss or a perceived loss for the client. They need to see that result. They sort of have to go through, make a complaint to a financial firm, and if that's not resolved, that starts going through those AFCA processes. And once again, what I'm looking at is the determination. So they're often at the end of that process. So there's a reasonable sort of time lag that it's really, that sort of 12 to 15 months after that substantial market downturn that you're starting to see the determinations that reflect that. What I thought was interesting is that as we started to sort of look at these determinations was just thinking about, I guess, my own practice and experience where I really sort of started advising sort of I described right into the teeth of the global financial crisis and the downturn that came with that in share markets. But actually, once we were sort of through that, and I've been running my own practice for sort of 9, maybe coming up to 10 years now. So in that period that I've been running my own practice, so responsible for not just my advice, but the whole sort of operation there. Prior to COVID, we really didn't have much of a downturn. There were a couple of sort of flat spots and, a few sort of periods where if you picked a particular sort of 6 or 12 months, you might have seen a negative return. But for the most part, diversified portfolios were just up. So you didn't get these, certainly these moments of negative returns, but I think in particular of those really sharp downturns, of which COVID was similar in scale to the global financial crisis and the drawdowns on markets, but it was completely different and very, very quick, both on the way down and on the way back up, compared to the global financial crisis, which was actually much more extended in time by comparison.
Yeah, that's interesting, isn't it? Because this leads to the conversations that you've had with your clients in the past, and the difference between planners who have been through those conversations with clients the first time or the second time to be able to then reapply those types of conversations versus planners who haven't had those conversations yet.
Oh, absolutely. I think when you get those moments, there's a big difference. How much, maybe not so much of the planner's experience, but even the pre-work you've done with the clients to sort of say, hey, at some point this is going to come, and this is sort of what it's going to feel like, and let's make sure we're sort of set up for that. It's. I think you do see a bit of difference in clients, partially reflecting, as I said, what pre-work you've done, also what prior experiences they've had and decisions they've made in the past as well.
Yeah, so understanding the importance of that pre-work conversations, setting or lining up for the prospect of when the next market downturn is. We don't know when it is, but there will be one at some point. And during that time, here is what our expectations are, how we'll all behave. Keep the plan on track, et cetera, et cetera.
That's right.
And do you think that then stems off a lot of these, the go to cash complaint moments that came out of the last sort of quarter, that April to June period? Do you think those pre-conversations could have had a lot to do with these complaints?
I think there's a number of things that you can sort of look at these complaints, and what I would say is actually, for the most part, the complaints have been found, in favour of the financial firm or the financial planner, so that they have done the right thing in terms of their conduct. But I think what it's sort of highlighted is probably looking more at, the client has, these complaints exist because the clients are unhappy with the results of what has happened. And what are the things that we could potentially do in advance to, build that awareness and understanding of, even the reasons, for example, that a financial planner will, for the most part, never ever say, you should go to cash because of a change in markets or a downturn in markets and things like that. What are the things we could do to actually explain that, sort of in the good times, so that we could, draw on that in the bad times.
Yep. Now, a lot of these, it's an interesting sort of complaint, because to me it sort of spans out over time, right? You mentioned sort of the 12 to 15 months, and of course a lot happened in that 12 to 15 month period. Obviously, markets dropped substantially. People got upset and nervous and worried. We know that people make decisions emotionally, and often, if they'd wanted to go to cash prior to that, they were going to be extremely upset that they hadn't got moved to cash before that. But then obviously hindsight's a wonderful thing to look back on and to be able to say, well, if you'd followed the advice, you're going to be in a better position now than you were, prior to the downturn. But how much of this is around really emotive and emotional factors versus logical and practical factors when it comes to the determinations? Because, as I said, people make decisions emotionally, not necessarily logically.
Yeah, so I think that's where the determinations are very much follow that logical sort of thought pattern, whereas the actions and the realities of that moment and perhaps the client perception is, as you said, extremely emotive, and so that's where I think it's looking at that disconnect where the determinations are saying the financial planner largely did what they should have. But also at the same time, the outcome for the client, has been one that we would all, do anything we possibly could in our power to avoid the client doing that. It's obviously, if there's a complaint made against you, it's a hugely stressful time for a financial planner, and somewhat relieving if that is resolved in a way that you haven't been found responsible for that poor outcome. But if you step aside from that for a moment, every single financial planner would just prefer that there wasn't the poor outcome for there to be a dispute about who was responsible for that. And that's where I think we can draw some sort of lessons and perhaps even build some better processes and into our practice, so that you'll probably never get rid of these sort of disputes completely, but maybe we can minimise that. That incidence of a poor outcome for clients, or these sort of misunderstandings and the like there.
Yep.
Yeah, I think some of these disputes have come from that a client has come in with a portfolio and said, "Hey, I'm concerned about this market falling, quite a lot," and the financial planner has, as we said, done what logically they should, is the correct advice, and said, "Hey, we're going to realise a large loss if we sort of cash out now. We need to stay the course," all of which is very, very good advice. But as markets have continued to fall, it's effectively gotten past that point, risk tolerance point for the client, and they've made the call to cash out. And in some of these examples, they have cashed out at a lower point than when they first started expressing that concern to their planner. And that's what's behind a lot of these disputes, is it then becomes it becomes disputed at what point did it move from a client concern to a client instruction.
Yep.
And that tends to be what sort of drives these disputes.
Yep. So tell us about some of these war stories, because there's a few of them that have come out of this in this quarter. Let's get into some of these, because I love the way that you approach this from the point of view of, how can we be better, better at our jobs, better planners, better advisors from the outcome of these by looking at these determinations and working out what could have been done to cut it off. Tell us about some of these exact cases that we've got here.
Yeah, so there was one determination, and you can look all these up on the AFCA website, and that's where I get them from. So the number for this one was 746832. And now this is probably more to do with, say, some of the actions before the downturn, because there had been some discussions with between client and planner saying, "Hey, look, maybe I want to reduce my risk profile," and this was around sort of August 2019. So that probably puts us, say, 6, 7 or 8 months before markets really started falling quite severely. Now, with the benefit of hindsight, the dispute has been, well, hold on, I said, from the client's perspective, back in August 2019, I was sort of saying we should be more defensive. That hasn't happened. And now we've gone into this severe downturn. They've cashed out in March 2020. And in this case, they probably had a fairly sizable portfolio, because the resulting loss or the difference between moving to cash in August 2019 and moving to cash in March 2020 was $200,000, so a substantial amount of money. Now, in this instance, that firm had, they were found to have done the right thing, in that there certainly was these indications that the client may wish to reconsider their risk profile, but they'd made quite substantial efforts to, address that with their client. And ultimately, the client had not responded to, and there was a number of records of advice in between the August 2019 and the March 2020 that sort of showed that, the financial planners had been listening to their client. They hadn't gotten that information. But certainly, I think it's the sort of dispute that, once again, if the record keeping had have been a little bit poorer, if there hadn't been those advice documents issued in the period between, there could have been potentially a different outcome, because it might have been more difficult for the planner to have demonstrated that they had done what they sort of should have or said they would. I thought there was an interesting sort of, sometimes you get these interesting quotes in these determinations. They asked this question but didn't answer it. But it talks about to what extent should a planner anticipate a COVID-19 downturn. So what they've said is, in normal circumstances, an advisor failing to meet his obligations to a client in respect to market-based investments must take responsibility for losses sustained because of market volatility. However, there is a question of whether the impact of COVID-19, a 1 in a 100-year event on the investments, is too remote to be reasonably foreseeable. Now, in this case, they go on to say, I find that because of the actions of the complainant and his wife, I do not have to resolve this question. So nice and easy for them to sort of raise a very difficult question and then just say, look, in this case, nobody needs to work it out. I think I read that, and I guess one sort of say disagreement I had with that is certainly, you might say COVID is a 1 in 100 year event. I think we would all certainly like to hope so, that it's not as frequently repeated. But I certainly think in practice, a severe market downturn, we should not be approaching the possibility of that like a 1 in 100 year event. I think even in recent history, the last 20 years is we've seen, they've all been slightly different from each other, but in the last 20 years, we've obviously seen the COVID downturn, but we saw the global financial crisis, which was a little bit more, sort of banking and financial system inspired. We've also seen the bursting of the dot-com bubble, which was, to do with the specific technology sectors. So I don't think we should be approaching our planning like these things don't ever happen. I don't think that people can anticipate the timing, but I think that with some sort of reasonable frequency, we should be expecting that that will happen. So that's probably my. I don't think you could excuse conduct, just by saying, well, COVID itself was 1 in 100 years. Who would ever see it coming? Because we're talking really more about just the impact of a severe and sharp market downturn.
Yep, and we've always been taught that there are market cycles, and there's no real number, but 8 to 12 years is sort of a very as a moment that's been talked about. So you're absolutely right. Expecting that and lining your clients up to anticipate that, I guess, is the key.
Yeah, that's right. Yeah, there was another determination, which was really that there was a lot sort of going in this one, but it's number 761581. In this case, it just highlighted that a client had completed a risk profile questionnaire in the past in about 2018. In 2019, the client sort of didn't want to complete a new questionnaire, so the financial planner, they just really sort of reaffirmed that risk profile that was completed in the past, and that was seen to be that was an appropriate sort of process, and I would say that reflects what I've seen from most licensees tend to have some sort of policy where they say, look, you don't need to do this every year, but they might have a threshold on that. They might say, but after 3 years, you probably should, or maybe it's 5 years. I guess also reflecting on our own practice, we might think about, well, there's some time factors that are quite common in, saying you can't use the same sort of questionnaire or profile without redoing it after 5 years, but also what are some of the events that might trigger that, even if you're still within your 3 or 5 year time period. Is it, might retirement be a trigger? Might divorce or, inheriting new money? What are those events that we might say, okay, look, I know I've done this in the past and maybe it was reasonably recently, but circumstances are different in a way we didn't anticipate. We should go back and do that again.
Yep, and I think with the risk profiling, it can get a bit blasé from time to time, but you mentioned risk tolerance previously. Completely understanding what their client's risk tolerance is and understanding at what point they're going to completely freak out and want to switch to cash.
Yeah, that's right. I think that it's very important because ultimately we are advisors, but the client is in the driving seat. So one thing that I think is very important is recognising that it's the client's risk tolerance that is more important than what our personal risk tolerance might be, because it's probably fair to say that on average financial planners have a higher risk tolerance than the wider public, because we've had a combination of, we've certainly had a lot of education along the way, which shows the value of holding through thick and thin. but we've also just had a remarkable amount of exposure, because even if we're actually not doing any investing ourselves, we're just seeing that in real time happening with our clients. So you just you sort of build up a very thick skin in terms of risk tolerance, that it then becomes incumbent on us to realise that the client has not had the same experience, so they may not have the same tolerance.
Yeah, that's understanding our own bias is an interesting point of view, isn't it? Understanding that our tolerance, based on our experience, is actually a bias, and to be able to make sure that we're either helping the client through it or understanding what theirs is.
That's right.
Now, just on because there was a number of determinations, obviously, with markets falling and people wanting to switch to cash, generally, as we said before, for emotional reasons. But tell us about like a lot of these determinations were in favour of the advisors, weren't they?
Yes, yeah. There hasn't been too many. There was really only sort of 2 or 3 that really reflected on that in that quarter. I'd hazard a guess that when it comes time to do the next quarter, there's probably going to be a few more that sort of look at that particular topic as well.
Yeah, I feel like there's going to be a few more that refer to the the early release of superannuation monies taken and the possible losses that could incur with that.
Yeah, look, I think, and this probably doesn't come into the ones that I look at because mostly they would have actually been unadvised. So, but you're right, there's potentially, if you look at disputes with superannuation trustees, I think potentially a lot there and a lot to do with the timing of processing, because at that point in time, whether a withdrawal was undertaken on a Tuesday or a Friday, there were times during that downturn where that's an 8 or a 10% difference in the value of the portfolio over the course of 3 days, and that's these are the sorts of things that really generate these disputes. Just in that case, probably less frequently with financial advisors, more so with the superannuation trustees themselves.
Yeah, no doubt there was a bit of fear and panic. Apart from the switch to cash conversations, what else did we see in this quarter?
Look, I think one that I thought was really interesting, more so from a long-term perspective, is it was actually in relation to somebody who'd taken out an equity release type product. So like a reverse mortgage, and the dispute was actually with the reverse mortgage provider. Now what had happened in that case is they'd basically taken out a reverse mortgage with a long-term fixed rate, but they'd done this in the sort of, I don't remember the exact timing, it was probably a year or so prior to the global financial crisis. Now, that's when interest rates had been steadily increasing, sort of a 0.25% or, every sort of month and things like that. So for probably, the course of 2 or 3 years, rates were just going up, and people's great fear then was, oh my gosh, these rates are just going to keep increasing. So they'd actually taken out this reverse mortgage and effectively fixed the rate. So at the time there, it was probably at something like 8 or 9%. What we've subsequently seen from the financial crisis and then beyond is just interest rates have absolutely sort of fallen through the floor. So there's been a big differential rate locked in there. What was interesting is once again, a really terrible outcome for the individual, but the determination sort of reflected that this reverse mortgage provider, they really followed all the steps they should have to warn about the risks and things like that. And this sort of determination, I think, would be very instructive if financial planners were more involved in things like equity release products, but also the pension loan scheme, which is somewhat like a reverse mortgage, was quite expanded. I think that's something that in the, I don't know the timeframes, maybe the medium term, financial planners will be much more involved with. I certainly think they should, because what these decisions really are retirement planning. and often people who are looking at these sorts of equity releases are also in receipt of age pension type benefits and potentially moving into aged care. So there's a lot of interaction with the social security system. There's a big issue right now that most of these products sort of sit under the credit licensing regime where most financial planners don't actually have the authorization to provide advice. That's something that I think that it would be great for that to be shifted, because I think that because of the retirement planning and the social security aspects, you really do need financial advice to go with it. But once again, you're able to see from a very extreme case where a client has had a very poor outcome, but the AFCA as the body has looked at, the outcome was poor, but the conduct was in this case, spot on. They did what they should have to investigate at that. So, if we get to the stage where actually, we are able to provide advice on these types of decisions under the licensing system, it's a really good indicator for then, what are the steps and how thorough do we need to be? Because particularly in this space, they're typically very large and very irreversible decisions. It was really good.
Yeah, it's interesting just on that, that a lot of planners can't provide advice on it, as you said, because they're not accredited to, or their licensees won't let them provide advice on it. And it kind of feels to me like it's a zone where there's a lot of advice warnings, not necessarily financial product advice, but a lot of, strategy type conversations should be had and warnings should be had outside of the product.
Yeah, look, I think it's something that, coming back to the global financial crisis and storm, is margin lending used to be regulated as a credit product and was actually brought into that financial products regime because it was seen as more tied to financial advice than it was to credit advice. I think long term, there possibly needs to be some sort of legislative change or things like that. I think around these equity release type products and probably particularly that pension loan scheme, which used to be quite narrow in its application, but the government has changed the law to really expand that. I think there is a process for us to be going and saying, hey, we think we should be providing advice on this. We would like to help people with this. But here's the reasons why. I think those licensees have been quite sensible under the current rules to say, no, you can't do that because it doesn't line up. So what we need to do is sort of say, hey, here's the reasons we think it's a good idea that we should be involved, and here's what we need you to change so that we can do that. Yep.
Fantastic. Now, you've got a little section at the end of your report called Odds and Ends. Let's quickly dive through some of those different things.
I think this is where sometimes it's just maybe interesting or a little bit funny or just topical, but not much. There was one determination. We've seen people losing money in cryptocurrency scams. So not just because that particular currency has actually performed poorly, it's just been a fraud. When people have lost a lot of money, they'll quite sort of naturally try just about anything, and often they're trying to say the bank that transferred the money, often overseas in large amounts, should be responsible. There's been a couple of decisions along the way which basically say that's not a duty that a bank really has. So there was one there. There was one around recontribution strategies, which just was, this is something that doesn't necessarily get examined a lot. Actually said, look, it wasn't poor advice that a recontribution strategy was done because it was reasonably likely in the circumstances here that the superannuation would have been exhausted in the superannuant's lifetime, not with substantial sums passed to non-dependents. You just don't get that sort of in writing a lot of the time. So it was interesting to see that. There was a decision that came out of one of the courts in Queensland, HAP2 and Bankia. What that sort of establishes that as financial planners, we have a very, very broad duty to warn clients about the risks of what they're doing. And I think what was a little bit perhaps eye-opening about that decision was that duty was probably found to exist quite extensively beyond the scope of the engagement with the client. In that particular case, the engagement with the advisor was more to do with investing some funds. What the client did that lost some money was more sort of starting their own private business. The advisor was found to have a responsibility in that particular set of circumstances to have more comprehensively warned the client of the risks of what they were doing. There's a decision here where that's probably just come back a little bit in that they've said, look, you have a duty to warn clients about risks of what they're doing, but if that client is also experienced in that particular area, so in this dispute it was about property investments, it's reasonable to not sort of have to give them every sort of warning under the sun, that you can assume that they actually have some experience that they can draw on themselves. And then a final one, look, I don't think anybody would find this surprising. I can't believe they actually did it, but somebody who issued a statement of advice, I think it was in something around 2006 or maybe 2007, and was providing advice with a record of advice 10 years after that, with no sort of advice in between. That's definitely... there's a lot of grey area sometimes in the rules about what's an SOA and what's an ROA. I don't think there's any grey about a 10-year differential between the two. But somebody tried.
Yeah, you're right there. Sometimes those finer things give you the best learnings. I think that one you're right. Doing an ROA 10 years after the SOA and referring to the SOA is not exactly best practice. No real learnings with that one, I don't think. Just highlighting that that's of course crazy. Michael, thanks so much for coming on and talking about the paper. Now you do these every quarter, which is fantastic. Tell us about where people can go to find them.
So I'm typically, I guess I publish them on, my website, so the michaelmiller.help there. And then the two places I typically share them is just myself through LinkedIn. But then where the majority of people probably see it is I typically post those on XY as well, just as a bit of a post there.
Yeah, fantastic. And they get a fantastic response. The XY community I think they look forward to them now, but they certainly love interacting and reading and starting conversations and threads of conversations about each one. So very much appreciate it, Michael. Thank you so much for coming on the podcast again and telling us all about that.
No problem.
Well, we look forward to continuing the conversation.
I'll keep reading the determinations.